So in this next video, we're going to look at how to prepare a bank statement reconciliation. So what is a bank statement reconciliation? So it's basically a document that explains the difference between the accounting records balance of cash and the cash balance according to the bank as we see on the bank statement. So keep in mind these are two entities keeping track of that entity's available cash. So the company's own cash account is its record of how much cash the company has, where when we get the bank statement sent to us by the bank, that's the bank's last known record of what the company has available, how much cash it has in its checking account. Often, however, the cash balance shown on the bank statement and the cash balance according to the cash account in the accounting records don't always equal out exactly. So differences between those two balances are common, and that's why the reconciliation at the end of each month is necessary. So the differences can be broken down into some general points here. So there are transactions that the depositor will already have recorded, so the company, transactions recorded by the company or the depositor, but not yet by the bank. So things like outstanding checks. So that's when a company has written checks and that money won't be subtracted from our account by the bank until those checks are actually cashed by whoever the checks were given to. So outstanding checks and deposits in transit. So that's when the opposite occurs, when the company / the depositor deposits a check, but it's after hours or it's a holiday, and that bank is not yet aware of the deposit that has been made. So on our end, we would have, as the company, increased cash once we got the check. Remember, we treat checks as cash. So once we receive a check, we will debit cash immediately. But the bank won't know about that increase to cash because we first have to cash the check and then wait for the check to clear. Same with outstanding checks. So when we write a check to someone, we treat it as cash. So immediately the company will credit cash within an entry, but the bank won't necessarily reflect that change until the check actually clears the bank, until the bank actually knows about that. Now, some other common explanations on the bank's end would be there are some transactions that are recorded on the bank statement by the bank that isn't yet recorded by the depositor / the company. So that would be like a service charge that's automatically deducted. The bank will do that immediately, but the company won't necessarily record that immediately. NSF checks, so that's non-sufficient. NSF stands for non-sufficient funds. So that's if a check bounces. So remember, if we deposit a check, we treat it like cash and we will increase cash right away. But if the check bounces, the bank will actually be the first to know that the check has bounced. So if there's an NSF check, we then would now, once we know about it, we would have to go back to our records and adjust that. But until we know about the NSF check, that's one reason why our cash balance would be not the same as what the bank balance is. Interest earned as well. So if the bank is paying us interest revenue, so if we have an interest-bearing account and we earn revenue on our interest on our balance, the bank will record that increase immediately, but the company won't necessarily. Until we actually get that bank statement, we can make adjustments for that. And any other miscellaneous charges or credits. So for example, if the bank collects a note receivable on the company's behalf, the bank will know immediately about that increase to cash, but the company won't necessarily, and that won't yet have been reflected in the company's cash balance on the accounting books. So now let's look at an example and actually set up a bank reconciliation here. So this example is pulled from the PowerPoint. So we have a list of transactions here, and we want to set up a bank reconciliation here to get the two balances to agree with one another. So you always want to start with the balance per the bank statement. So that's what we're going to do first here, and we'll do it on the right-hand side here. All right, so we want to put the title of the company, then the title of what we're actually doing here, and a date. So we want to start first with the balance per the bank, or per the bank statement. We'll do July, they noted it July 31st, 2021. I think the actual date is on here. So let's see what they tell us. It says the July 31st bank statement for Parkview Company indicated a cash balance of $5,000.17. So this is the first balance that you start with. So now we want to make any necessary adjustments to the bank balance to adjust it to the actual balance that it actually really is, and really will be once some of these timing differences and things will be adjusted on the bank's end. So we want to look at this list and see, okay, well, remember we said that some things on the bank's end that will lead to some differences in balances would be outstanding checks and deposits in transit. So these are things that the bank doesn't yet necessarily record at the same time that the depositor does. So we want to look, are there any outstanding checks or deposits in transit here? So let's take a look. It says on the third point, 4 outstanding checks totaled $717.75. So let's just check off that we've done this first one. And we want to see if there's a breakdown at all of the outstanding checks. So let's see here. Doesn't look like it. So keep in mind, usually you will get a breakdown of each check. So you would list each check on its own. And but here they give us the total. So we found the outstanding checks amount, and we want to see if there's any deposits in transit. So let's see. On the next point, it says a $410.90 deposit was made after banking hours on July 31st, and this doesn't appear on the bank statement. But we know about that deposit, and we treat a deposit of a check as cash. So we want to take this outstanding check amount on this deposit and add it to or mix it into the balance per the bank, because this $5,000.17 is what the bank thinks the company has in terms of cash. So first, let's add the deposit in transit. So looks like there's one here, deposit in transit. So that's something that we've recorded on our end on the books, but the bank doesn't know yet because that deposit was made after hours. So we would add that $410.90 to the bank's balance according to the bank statement. But outstanding checks are the same idea, except it's not cash coming in, it's cash going out. So once we write those checks, we would already have recorded that on the books, but the bank doesn't yet know about outstanding checks. They haven't yet gone through. So when it comes to outstanding checks, you want to deduct those from the bank balance. So deduct outstanding checks. So like I mentioned on the homework, and usually you would list each check on its own. So after we write deduct outstanding checks, we write each check number and the amount itself. But here they give us the overall amount, so we're going to subtract the $717.75 as an overall outstanding check amount. So you want to go through this list and make sure there's nothing that needs to be adjusted in terms of the bank's balance. We see here's a service charge, but that's on our end. There's an error here. There's interest and an NSF check. So all of those would be adjusted for our record. So that seems to be it for the bank's balance. So once you make any changes to the balance according to the bank statement, we will include another line item here called adjusted cash balance. So we're going to take a calculator, and we'll take that $5,000.17, add the deposit in transit, and subtract out those outstanding checks. So that leaves us here with an adjusted cash balance of $4,693.32. Okay, so our goal here is for this cash balance to match up with the adjusted cash balance when we're done adjusting the balance per the books. So next, once you've adjusted the balance per the bank, you want to write balance per the books. So just keep in mind here that there's different ways that this can show up. It might show balance per books, or the other way you'll see this is balance per depositor's record. So that's just what does the cash account say our balance in a cash is. So let's take a look. So far we've finished off with that first bullet point. We're done with this one, and we're done with this one. So we want to take a look. Okay, well, the balance per the books, it says that the cash ledger account on that date shows a balance of $4,262.83. So we'll write $4,262.83. So that's quite different from what the bank statement says is in our checking account. So we want to adjust this now. So remember, what are things that that would cause our accounting records cash balance to differ from the bank statement balance? So we said things that would be things that the bank has recorded but we haven't yet. So things like service charges, NSF checks, interest earned, miscellaneous charges and credits, and also mistakes. If the bank makes a mistake on how something is recorded, not if the bank makes a mistake, but if we make a mistake on how something is recorded on the books, but it clears the bank for a different amount, and we realize, oh, oops, we recorded that amount incorrectly initially, then we would also have to make that adjustment here. So let's go through and make these adjustments. So let's take a look. So we see here there was a check returned by the bank. So one of our customers that we received payment from, $50.25, that check bounced. We see here that we earned interest during the month of July in the amount of $24.74. It says the check 893 for telephone expenses cleared the bank for $85, but we accidentally recorded it as $58. And then finally, the bank charged a July service charge of $12. So let's first add any additions to this amount, anything that will increase that balance. So we can see here, it looks like we earned interest, right? So if we look at this one, it says the bank statement showed $24.74 of interest earned on the bank balance. So we haven't yet recorded that. It says the bank also collected a non-interest bearing note on July 22nd for $500 and charged a $5 collection fee. So here we have in one little bullet point a couple of things rolled into one. So we have $24.74 of interest earned. And then we collected a non-interest-bearing note, or the bank collected a non-interest-bearing note on July 22nd for $500. So the bank collected $500 from a customer from us. So a $500 collection. So the bank collected the $500. So we haven't yet recorded that. But the bank charged a $5 collection fee. So these two represent additions, but there's a $5 collection fee that we will adjust separately. So we want to first just deal with the additions. So we will first add the note receivable collected by the bank. So that is an addition of $500 that we'll add in. And then there was also interest earned. Interest earned on our bank balance, and that is the $24.74. And that looks like, after we looked at all these other bullet points, those are the only additions, things we have to add to our cash balance that we haven't yet recorded. So the next thing is we want to subtract out any deductions necessary. So let's take a look here. So we have this NSF check. So far we have this collection fee. So let's look at things that would need to be subtracted. So we have a collection fee. We have, let's see here, an NSF check of $50.25. So a check that bounced. And we have this error that needs to be corrected in a bank service charge. So we have a $12 service charge. And let's see what that error is. So it says we recorded the expense, that a payment of cash as $58, but it was actually a payment of $85. So we just made a mistake in our journal entry. So that's a mistake of $27. So we only reduced cash by $58 when we should have reduced cash on the books by $85, because $85 is what we actually paid. So we need to deduct another $27 from our cash balance on the books. So that's a error on the check recording, that as far as the journal entry is concerned. So now we have to deduct all of these. So let's deduct the collection fee here. So that's $5. So that one's dealt with. Let's deduct the NSF check. So remember, this is when we get a check from a customer, we record it as an increase to cash on our books, but if the check finally ends up bouncing at the bank, then the bank never deposits that money. So then we have to make sure to subtract out the NSF check once we find out about it. So NSF check, that's for $50.25. We have a service charge for just the bank services that automatically they charge to our account. We haven't yet recorded that on the books. And then finally, the error that's on check 893. So we ended up writing the check for the right amount, and we gave it to the telephone company, and the check cleared for $85. But when we went to journalize that transaction, we accidentally only reduced cash by $58. So we actually now have to further reduce cash by another $27. All right, so that looks to be like all the adjustments needed. So now we can find the adjusted cash balance after we add and deduct all these things from the balance per the books. So the goal is for this number to be the same as the adjusted cash balance when we made changes to the balance per the books. So you start with the balance per the book, so that's $4,262.83. Add the note receivable collected by the bank and add the interest earned. Now we subtract out all of these decreases. So we subtract out the collection fee, subtract out the NSF check, we subtract out the service charge, and we subtract out that accounting error. So that looks like our adjusted cash balance here is $4,693.32. And that, in fact, matches up with the adjustment we made up above. So we've successfully reconciled the balance per the bank statement and the balance per the books. So the adjustments we see up here, the deposit in transit and outstanding checks, time will deal with those. So eventually the bank will add the $410 to our cash balance, and we'll subtract out the $717. Time will deal with that. But the thing is, for these adjustments made on this reconciliation to our books, that's not just going to magically get adjusted. We actually now have to journalize to make these adjustments to the actual cash balance. So we can do one entry for the overall increase to cash and one entry for the overall decrease to cash. So let's deal with these two first. So how much did cash actually end up, how much does cash need to be increased on the books for those two amounts? So we know that the bank received $500 that it collected from a customer of ours, and we earned interest of $24.74. So our cash went up by $524.74. So the bank knows that, but we haven't yet journalized that. So here's where we need to journalize that. So we will debit cash for $524.74. And now if we collected a note receivable from a customer, that has been satisfied. So then we would have to credit notes receivable if that customer now no longer owes us that amount. So we will credit the notes receivable for $500, and we will credit interest revenue for $24.74 because we earned revenue on our cash balance. So that if you earn interest, it counts as revenue. So that's the journal entry to, on the books, actually increase our last known cash balance. Secondly, we want to record the overall decrease to cash. So that would include these items right here. So let's go ahead and include the collection fee and the service fee as one. We'll add that all into one account because all of those would qualify as a bank service charge. So a bank service charge, that would be considered an expense. So let's debit an account called bank service charges. $12 plus 5 is $17. And then this NSF check. So how do we deal with that? So when you receive the check from your customer initially, you will debit cash and credit accounts receivable if they're paying you off now by giving you a check. So that's what we would have initially recorded, is a debit to cash and a credit to accounts receivable. But now that check has bounced and we never received that cash. So now we need to reverse that. So to reverse that, we put the accounts receivable back. Because if that customer's check bounced, they still owe us now, since we never received their money. So we're going to debit accounts receivable for the amount that we never ended up getting. The customer now owes us once again. And then lastly, remember this error on this check here. The bill was for $85. The actual telephone bill was for $85. That's how much we wrote the check for. We got that right, but when we actually recorded the expense, we did that incorrectly. So we accidentally recorded the telephone expense as $58. So we increased telephone expense for $58, and we accidentally only reduced cash or credited cash for $58. So we didn't record enough of an expense, and we didn't reduce cash enough. We should have debited expense for $58 and credited cash, debited expense for $85 and credited cash for $85, but we accidentally put $58 there. We flipped those numbers around on accident. So to fix this, so far, $58 has been recorded as telephone expense, and $58 has been taken out of cash with that initial entry. So to fix that, because that should have been $85 instead, we'll just increase that telephone expense and reduce cash by another $27. So to fix that, we'll further debit telephone expense, but just for the amount that we forgot to add in. And then now we're going to credit cash for all of these deductions. So we're just doing all of these three entries as one. So let's take 17 plus 15, 50, 25 plus 27. So we're going to overall credit cash for $94.25. So on Connect, keep in mind it's one thing to do the actual reconciliation, but then you actually have to do the proper journal entries to actually adjust officially on the books the cash balance within the ledger, because this old balance here is what we thought the cash balance is, but now once we see that bank statement, there are some adjustments we have to make to that cash balance on the books by recording these journal entries.